Welcome to Real Finance, your number one place for financial education. Today we will delve into bonds. If you have not watched last week's episode, here is a good time to pause and learn about the basics of stocks which build on the understanding of bonds. For any structured organization, there generally are two ways to raise funds. For publicly traded companies, that includes issuing stocks, which give the buyer a percentage of total shares of a company, which we discussed last week. However, they have another tool in their toolbox called a bond. A bond is essentially a loan made by an investor to a corporation or a government that provides the investor with a fixed income in return. A good example is the U.S. 3-month Treasury bill. A Treasury bill is an interchangeable term with the word bond. The U.S. government will issue a bond to borrow money from an investor to raise funds for schools, roads, dams, etc. In return, the U.S. government will provide the investor with a fixed income rate on the amount borrowed. Historically, this rate has been around 4.3%. So if you bought a $100 3-month Treasury bill, historically you would have made $4.30 on your investment less the rate of inflation over that period of time. Once the bond has matured, the bond issuer must pay back the face value of the bond. In this case, 100 plus interest. A bond does not have to be held to the maturity date and can be sold and rebought in order to make more money than just the principal plus interest rate. The value of a bond varies inversely with the interest rate. For example, imagine a bond issued at 5% with a face value of $1,000. The holder of that bond will be paid $50 in interest income annually. However, if interest rates begin to decline, such as is the current situation, the original bond becomes more valuable because investors who want a higher interest rate will have to bid higher than the face value to entice the bondholder to sell the bond that has a better interest rate. On the other hand, if interest rates rise, the bondholder with the 5% interest rate is no longer attractive, the bond's price will drop. So how do you pick when to buy stocks and when to buy bonds? Generally, this decision is individual and should be based on the amount of risk you can tolerate. Government bonds are regarded as one of the safest investment tools you can own because your fixed income in principle is backed by the full faith and financial health of the U.S. government. For example, if there is a period of volatility in the economy such as a coronavirus pandemic, owning bonds would be a safe way to mitigate your risk to the volatile economy. Even though interest rates are low, those bonds you hold would have a higher face value. I would like to share two quotes from one of my favorite financial books, The Intelligent Investor by Benjamin Graham. People who invest make money for themselves, people who speculate make money for their brokers. The second, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. So understand the risks between stocks and bonds. Generally, it is good principle to have 50% stake in bonds and 50% in safe, large-cap stocks. When volatility is high, you can move assets to more of a bond-heavy portfolio. When volatility is low, you can move to a more security or stock-heavier portfolio but not sway too much to either side. Keep your financial health in your own hands and subscribe to our channel, where our goal here is to keep your finance real.